and there's a strict risk to return relationship that you can't beat, and this is only optimized through asset allocation and diversification. So the flaw in this is the same. Markets are shown not to be efficient, and investors are not rational because, given the same information, they interpret it differently. And as super investors show, people are able to beat the market consistently with higher return given the risk they're taking on. Okay, and so now we get to our super investor index. And so these are the 8 I picked, and then the 2 that I added on were Prem-Watsa and Wallace-Weitz. And the interesting thing about these is, yeah, like I was saying, they all have different ways to work off the value investing fundamentals. So someone like, let's see, Chuck Acre, he has 40% of his holdings in 4 different companies, whereas some of the other investors will have hundreds or tens of different securities, partially diversifying, partially just having a wider variety of stock picks. And so someone like Ian Cummings as well, he has a lot of his capital in distressed companies that he invests his money in and tries to revive to make the stock price go back up and make it realize its full value. And that's maybe not something that other super investors would do because of the risk associated with that, but that's his method. And Prem-Watsa, a lot of his capital is in technologies. Weitz, a lot is in services. So yeah, there's no set way to be a value investor. There's fundamentals of it, but each of these are putting their own twist on it. And so here are the average returns over 20 years for them. Yeah, this will be the hardest one to see how effective they are. You can see slight gains over the indexes for most periods, but again, this is part of what their goal is that you can't just looking at this see the full effect of what they're doing. You can see they have lower standard deviation, so what would be defined by most as risk, and they have higher returns over 20, 15, and 10 years than the indexes. But let's see, the biggest way you'll see it is through cumulative returns. And so the value investors are working long term. They're working off of compounding returns, and they're perfectly fine. Warren Buffett's picks have often been called boring because they're not doing a ton, but they're consistently beating the markets. And over long term, this is very clear. And this shows the real effect of what they're doing is that over long term, they're blowing the other indexes out of the water. And so here's the numbers. Basically the graphs, but in more confusing looking. So rolling returns. This was really interesting to me. Rolling returns are used because when you look at year to year, it doesn't always reflect exactly what was happening with you can look at a certain year where they didn't do as well, and you might think they didn't do as well. But with a 10-year rolling, you see their long-term performance. And so this is perfect for the value investors with their long-term goals. It shows that they are very, very consistently every year with 10-year rolling, they're beating all of the indexes. And let's see, they had lower standard deviation than the S&P and higher than the Russell. And that could be interpreted to think that they're performing worse than the Russell because of their standard deviation, but their return premium over the Russell outweighs the standard deviation that they're taking on from this. And so this is a very important thing to realize about super investors, that over the long term they are very obviously beating the indexes consistently. And so on the 5-year, yeah, this is interesting because there was periods where they weren't beating it, and it fell below the S&P in a few periods and fell below the Russell 2000 in some periods. While overall it was beating both of the indexes, it definitely has to be noted that it fell below. And this shows that they really are doing a long-term approach. They're not worried about shorter periods as 5 years and more worried about 10 years, letting their securities realize their values, and it's one of the fundamental things needed in value investing is the patience to allow securities to realize their values, and not letting small downturns divert them from their goals. And it's one of the things value investors harp on, is that risk is not that their investment is going down, but it's that when they sell it, they're not losing money. And so just because their investment is taking a downturn doesn't mean they're ready to sell it, because they know the value, they know the margin of safety they have on it, and so they're able to wait it out and allow their securities to reach their value. Yeah, so here we can see in 2 periods the S&P beat it, and 3 periods the Russell beat it. So it shows the larger picture of what the super investor aim is to beat the indexes consistently over the long term, and they're very well doing that. This was really fun, the efficient frontier. So as we can see, this is showing that the super investors were beating the modern portfolio theory. So I took the 20-year averages from the S&P 500 and the 20-year average from the Barclays Aggregate Bonds Fund, and so with that you take the expected returns given the weighting, and then the portfolio standard deviation given the weighting. So the line you end up with is the slightly curved line, and then the capital allocation line is what the optimal will be, and so that's taken by finding the optimal weight of 1, and then doing 1 minus that weight, and then finding the expected returns and the portfolio standard deviation of that. And so the equation for that was, let's see, is 0.427 plus the risk-free rate, which is 0.082, and that was taken from the 10-year average 20-year for 20 years of the 10-year Treasury bond. And so this very clearly shows that the super investor index is beating this capital allocation line and beating the expected risk given, or the expected return given the risk they're taking. And so we can see that here. Given the capital allocation line, with the risk they're taking of 17%, their expected return should be 12.1, given perfect diversification and asset allocation. But instead they had returns of 14.2%, showing they clearly were beating the indexes with, like on their own terms, they're beating them on the terms of risk to return, showing a higher Sharpe ratio than the line had. So again, they're showing they beat both of these theories by showing consistent abnormal returns over the market and given the risk they're taking. So they beat the modern portfolio theory with by beating the capital allocation line and getting a return that was over 2% higher than the expected return given the risk they're taking. And they're able to do this not through diversification, but through picking stocks that were more highly valued than the stock prices were showing. So they consistently can beat it for 20 years. And so when considering this, I would be very comfortable investing in this because, the results show they're very easily beating the indexes and they're doing it consistently. So given my age, this would be the top choice for investing because if you have the opportunity to have higher returns with less risk, you take it. It's very obvious if you are able to do it, then you should do it. You should take higher return with less risk. Given my mom or someone around her age, it would also be, it would be a smart choice given the results of the method, but there would be some caution onto whether they will reach retirement or they will need their money back in less than 10 years and might be in those 2 periods or the 4 periods against the Russell where they are getting returns that are lower than the indexes. So the time horizon would be key here because super investors are looking long term and have a longer time horizon. It may not be a perfect fit for someone who is nearing retirement or needs quick access to their capital because they may not be able to let the securities realize their full value.
That's why we have the retirement group.
Yeah. So the secret to this is consistent returns, not blowing it out of the water, while in some periods they did, but consistently beating the market. In downturns they beat it, and upturns they beat it. And so the compounding returns of this starts adding up and makes it really beat the market over the long term. Another secret is, and probably the most amazing thing they do, is a paradox between lowering the risk and raising the return. So by having a larger margin of safety, finding a company that has a deep discount, they lower their risk because the asset will be lower priced, while raising the opportunity for return when the security fully realizes its value. And that's something it's very unheard of in the market. The market is you take risk and you get return, a higher risk, higher return. But the super investors flip that around. And interesting, they focus on particular value stocks, some of them choosing only a few and putting their full confidence in that, putting most of their capital in that, rather than knowing 100 stocks, barely knowing each of them. They're able to do what they're very confident in, and not have to worry about diversification, asset allocation, even though some of them do that. That's not what they need to focus on. And lastly, the big secret for them is that they're patient. They know their method, and they're willing to wait for the securities to realize their values. Again, that's why the 10-year rolling return is so evident, is because they're willing to keep it in even in downturns, and they know what they value the company at, and they're willing to wait for that. So it takes a disciplined person, which is, again, why value investing is not the most popular method, because people get scared and they want to take their money out before their assets are able to reach their full value.
Yeah. Perfect example of that is just your cumulative return slide, where you're barely even beating the market, or you're barely even beating the S&P and the Wilshire for the first 10 years. So you can see a lot of people getting really frustrated by that. But it's just exponential growth after that. That's probably my favorite slide on this one.
Yeah. I think that was the biggest thing I realized is, every once in a while I look at Berkshire and look at their stocks, and while they're performing well, they are just beating the market, but that's all they need to do. They need to consistently just beat the market. It really shows up over the cumulative returns.